This segment is used to prepare the environment for time series analysis and creating an ARCH, autoregressive conditional heteroscedasticity, model. Here is an overview of the functionalities. 1. Install the ARCH package by running pip install ARCH. This package offers tools for modeling the conditional variance of a time series, essential for ARCH modeling. 2. Importing required libraries and functions. Math for mathematical operations. Time from time for time-related operations and performance measurement. Pandas as PD for data manipulation and analysis. NumPy as NP for numerical operations. Matplotlib. PyPlot as PLT for data visualization. Datetime. Time delta from datetime for handling dates and time. Plot_ACF. Plot_PACF from statsmodels. Graphics. TSA plots for autocorrelation and partial autocorrelation plots. Train_test_split from sklearn. Model_selection for data splitting. Mean_squared_error. Mean_absolute_error from sklearn. Metrics for model evaluation. ARCH_model from ARCH for the ARCH model. Warnings for managing warnings. 3. Set the plotting style using PLT. Style.use, 538, for consistent graph visualization. 4. Suppress warnings with warnings. Filter warnings, ignore, to enhance output clarity. 5. Include %matplotlib inline to display all matplotlib plots inline in Jupyter notebooks. In essence, this code arrangement organizes the environment by importing necessary libraries, installing the ARCH package, and configuring settings for plotting and warnings. These steps are fundamental for conducting time series analysis, visualizing data, and constructing an ARCH model in Python. This snippet uses the Pandas library to read a CSV file containing Bitcoin price data. It reads the CSV file with PD. read_CSV function and stores it in a dataframe named df. By setting parse_dates equals true, it ensures that the datetime column in the CSV file is interpreted as dates in the dataframe. Then, it renames the datetime column to date, using the rename method, and sets the date column as the dataframe's index. By converting the index to datetime format using pd.to_datetime, it ensures that the index is recognized as dates. Lastly, it plots the close column from the dataframe using the plot method with a specific figure size. In summary, this code reads a CSV file, pre-processes the data by renaming columns and setting the index as dates, and then visualizes the closing prices of Bitcoin over time. Utilizing this code is essential for reading and manipulating the data in a structured manner for analysis. By employing Pandas dataframe, it offers a robust and adaptable approach to work with tabular data, simplifying tasks such as data manipulation, cleaning, visualization, and analysis on the dataset. This snippet of code performs the following actions. 1. Resamples the dataframe df to calculate the mean on a daily frequency and saves the result as ddf. 2. Computes the daily percentage change in the close column of the resampled dataframe ddf, removes any missing values, and scales the result by 100 using the formula current value, *100. 3. Visualizes the percentage returns using matplotlib with a figure size of 16 by 8. 4. Defines the x-axis limits of the plot to cover the entire range of the returns data frame. This code is beneficial for financial analysis, especially when dealing with time series data like stock prices. Resampling the data to a daily frequency and calculating daily percentage changes can aid in studying the volatility and trends in the data over time. The plot provides a visual representation of the daily returns for analytical and decision-making purposes. Setting the x-axis limits ensures that the plot displays data within the relevant time frame. This process accomplishes the following tasks. 1. Initiates an instance of the ARCH autoregressive conditional heteroscedasticity model with the ARCH_model function, passing the returns data. 2. Fits the ARCH model to the returns data by utilizing the fit method, with model updates occurring every 5 iterations. 3. Displays a summary of the model fitting results using the summary method. 4. Generates a plot depicting the annualized volatility using the plot method from the fitted model. The ARCH model is frequently employed in finance to represent the volatility of financial returns. By applying an ARCH model to the returns data, we can gain a deeper understanding of volatility patterns and dynamics within the data. This model enables estimation of the conditional variance of returns based on past volatility, aiding in better decision-making for risk management and forecasting. The summary and plot offer valuable insights into model parameters and volatility patterns within the data. This snippet pertains to time series analysis, specifically fitting an ARCH model to financial returns data. Here's an overview of its functionalities. 1. The ARCH_model function initializes an ARCH autoregressive conditional heteroscedasticity model with specified parameters for autoregressive terms p, exogenous variables terms o, and moving average terms q. 2. The fit method fits the ARCH model to the provided financial returns data. The update_freq equals 5 argument determines the optimization routine update frequency, while disp equals off controls the display of optimization messages. 3. Printing res summary displays a summary of the fitted model, including model fit, parameter estimates, standard errors, p-values, AIC, BIC, and more. This summary is crucial for evaluating the model's performance and validity. 4. Res plot annualize equals d generates a plot showing the annualized volatility predicted by the fitted ARCH model. This plot visualizes the volatility dynamics captured by the model over time. Utilizing an ARCH model in financial time series analysis is vital for capturing volatility clustering and time-varying characteristics of asset returns. Fitting an ARCH model enables a better understanding and potential prediction of future volatility patterns in the financial market. Such analyses are essential for portfolio management, risk assessment, and financial forecasting. This text explains how an ARCH model is applied to a given return series. Initially, an ARCH model object is created with specific parameters like p, o, q, and power. ARCH models are commonly used in finance to depict volatility clustering in financial time series data. Next, the fit method is invoked on the ARCH model object to estimate the model parameters based on the input return series. The update_freq equals 5 parameter ensures that progress updates are displayed every 5 iterations during the fitting process. Lastly, a summary of the fitted model is printed, containing statistical details, parameter estimates, and goodness of fit measures. This summary aids analysts and researchers in comprehending data properties and evaluating model performance. Practically, utilizing this method assists in analyzing and modeling financial time series volatility, a vital aspect for risk management, asset pricing, and other financial applications. This explanation details the use of the ARCH, autoregressive conditional heteroscedasticity, model to analyze financial returns data. 1. Creating the ARCH model instance. The ARCH_model function is used to create an instance of the ARCH model. The returns variable contains the financial returns data to be analyzed. Parameters p, o, and q dictate the lag orders for the autoregressive, exogenous, and moving average components. The power parameter specifies the transformation applied to the volatility process, while the dist parameter determines the distribution, in this case, a student's t-distribution. 2. Fitting the model. The am.fit method is employed to fit the ARCH model to the data. The update_freq parameter controls the frequency at which the optimization algorithm reports its progress. 3. Displaying model summary. The print, res. Summary function prints a summary of the fitting results, showcasing statistical details of model parameters, goodness of fit measures, and other pertinent statistics. This code aids in modeling and understanding conditional heteroscedasticity in financial returns data, enabling analysis of volatility clustering and leverage effects commonly observed in financial time series data. The ARCH model serves as a vital tool in quantitative finance for risk management, asset pricing, and portfolio optimization. This snippet performs the following tasks. 1. It sets parameters in a time series model using the fix function from the AM module with specific values. 2. It displays a summary of the fixed results by using the summary method on the fixed_res object, showing statistical information regarding the fixed parameters. 3. It creates a data frame, FDF, that combines conditional volatility values from two objects, res and fixed_res. 4. Column names, estimated, and fixed, are assigned to the conditional volatility columns in the FDF dataframe. 5. It plots a side-by-side comparison of estimated and fixed conditional volatilities using plot, with the x-axis limits set to a specified range. This code aims to analyze and visualize the impact of fixing certain parameters in a time series model on the conditional volatility of the data. Comparing estimated and fixed conditional volatilities helps assess how changing model parameters affects the model's behavior. Understanding the stability and potential bias introduced by fixed parameters is crucial for model evaluation. This process involves fitting an autoregressive model to financial return data. Here is an overview of the steps performed and their significance. 1. Calculate the financial instrument's returns by computing the percentage change in the closing price with a lag of 12 periods. This analysis is widely used in finance to assess asset performance over time. 2. Construct an ARX, autoregressive model with exogenous inputs, model object with lag values of 1, 3, and 12. Autoregressive models forecast future values based on past values in the sequence. 3. Fit the model to the returns data using the .fit method to estimate the model parameters based on the provided data. 4. Display a summary of the model using the summary method, showcasing crucial details like parameter estimates, standard errors, and statistical tests. This code is crucial for financial analysis and forecasting as it aids in uncovering patterns and relationships within financial data. Autoregressive models are frequently employed in finance to predict future asset prices or returns, offering valuable insights for decision-making in trading or investment strategies. The ARCH method from the ARCH library is utilized to fit an autoregressive conditional heteroscedasticity (ARCH) model to a given time series data. The ARCH method models the volatility of a time series as a function of its own previous squared values. The code performs the following steps. 1. Creates a univariate ARCH model with a lag order of 5 using the ARCH p=5 constructor. 2. Fits the model to the data with update_freq=0 to suppress progress updates and disp=off to hide display output during the fitting process. 3. Prints a summary of the model fitting results using res. Summary. 4. Generates a plot of the fitted model with res. Plot. This code is beneficial for analyzing financial time series data or any dataset where data volatility changes over time. Fitting an ARCH model helps in understanding and quantifying volatility clustering. The summary and plot offer insights into the model parameters and its fit to the data. This program uses the ARCH library to fit a student's t-distribution to data. Here is the breakdown of the program. 1. It imports the student's t-class from the ARCH univariate module. 2. It creates a variable named AR distribution, which is an instance of the student's t-class representing a student's t-distribution. 3. It fits the student's t-distribution to the data using the fit method with parameters update_freq=0 to avoid progress updates and disp=off to disable display output during fitting. 4. Lastly, it displays a summary of the fitting results using res. Summary. This code is utilized to determine the parameters of a student's t-distribution that best describe the given data. This is commonly applied in financial modeling and risk analysis to accommodate heavier tails and an increased probability of extreme events compared to a normal distribution. This text describes a process for modeling financial data using a GARCH, generalized autoregressive conditional heteroscedasticity, model. 1. A GARCH model is built with the ARCH_model function to estimate volatility in financial time series data, accounting for volatility clustering. 2. The GARCH model is then fitted to return data to determine its parameters. 3. A forecast for the next 5 time steps is generated using a simulation-based method with the forecast function. 4. The residual variances of the forecasted data for the last 3 time steps are displayed. 5. Simulations are conducted on the forecasted data to explore potential data paths. 6. A plot is generated to visualize the simulated residual variances and expected variance for the next 5 time steps. This process aids in estimating and forecasting volatility in financial time series, offering valuable insights for risk management, portfolio optimization, and trading strategies where accurate volatility estimation is critical. This text describes the process of creating a boxplot using the Seaborn library. The boxplot function from Seaborn is used to generate the plot based on provided data. In this case, a boxplot is created for the variance data stored in the variable sims, variances, -1. A boxplot is a graphical representation of data distribution using a 5-number summary: minimum, first quartile, median, third quartile, and maximum. It helps in visualizing data distribution, identifying outliers, and understanding data spread and skewness. Seaborn simplifies the creation of aesthetic and informative statistical graphics in Python, allowing for the generation of complex visualizations with minimal code. This code facilitates the visualization of data variance, aiding in the identification of patterns and outliers in the dataset. The process involves generating forecasts and displaying them in a plot. Here is an explanation of the steps. 1. Calls the res. Forecast method with parameters specifying a forecast horizon of 5 time steps, using the bootstrap method, and not reindexing the forecasts. 2. Extracts simulations of the forecasts from the result and assigns them to the variable sims. 3. Plots the simulated paths of the forecasts using residual variances. It selects every fifth value in the last row of the residual variances and plots them against corresponding x values with a specific color and transparency. 4. Draws a line to represent the expected variance of the forecasts at the last time step using values from forecasts. Variance. ILOC, -1. 5. Sets x-axis ticks to correspond with values in x, and sets x-axis limits from 1 to 5. 6. Adds a legend to the plot to differentiate between simulated path and expected variance. This code is essential for visualizing and comparing simulated forecast paths with the expected variance over time. It aids in understanding the uncertainty in forecasted values and offers insights into the potential range of actual values based on simulation outcomes. This text discusses the implementation of a time series forecasting model. The process likely utilizes a library referred to as res to predict future values for time series data starting from January 1, 2020. Here are the key points regarding the code's functionality. 1. Generation of forecasts for the time series from January 1, 2020, without reindexing the data. 2. Calculation of the conditional mean and variance for forecasted values in the year 2020. 3. Extraction of quantiles, percentile points, at 1% and 5% levels from a specific distribution. 4. Display of the quantile values obtained in the preceding step. This code is crucial for forecasting future values in time series data by leveraging historical patterns. By generating forecasts, computing mean and variance, and extracting quantiles, the code facilitates informed decision-making concerning time series data analysis. The quantile values offer insights into potential future value ranges and uncertainty levels. This program calculates the value at risk, VAR, for a financial time series and visually represents it. Here's a summary of the process. 1. It computes the VAR using the formula cond_mean, SQRT, cond_var, Q, where cond_mean is the conditional mean, cond_var is the conditional variance, and Q is a quantile level. 2. A data frame is created with VAR values for quantile levels of 1% and 5%. 3. A plot is generated to show the VAR values without a legend. 4. The x-axis range of the plot is adjusted to match the VAR index. 5. Returns data for the year 2020 is copied and stored in the variable rets_2020. 6. Data points are colored based on whether returns exceed the VAR threshold for 1% or 5% quantile levels. 7. Different markers and labels are used for data points based on the exceedance level. 8. Data points are plotted on the same graph according to colors, markers, and labels. 9. Title and legend are added to the plot with 3 columns and without a frame. This code helps in analyzing the potential downside risk of an investment by comparing calculated VAR with actual returns. The visual representation aids in assessing risk exposure, guiding risk management decisions, and shaping investment strategies. The use of color-coded markers and labels enhances the interpretability of exceedance levels for different quantiles. This process calculates standardized returns for the year 2019 by using data from a data frame called returns. The standardized returns are then normalized by dividing them by conditional volatility values from an object named res. The code then eliminates any missing values from the standardized returns and computes the first and fifth percentiles of these values. Standardization removes the impact of the mean from the returns and adjusts the values based on conditional volatility. Analyzing the percentiles of standardized returns helps in understanding the distribution and spread of the data. This analysis is commonly used in finance to assess investment performance, manage risk, and make decisions based on statistical data. Calculating percentiles aids in setting risk management thresholds and identifying data outliers. Consequently, this analysis supports investors and analysts in making well-informed decisions within the financial sector. This text discusses risk management in financial investment. Here is a summary of the key points. 1. The code calculates the value at risk, VAR, using a specific formula. 2. It creates a data frame with VAR values at 1% and 5% levels. 3. The code generates a line plot to visualize the VAR values. 4. Different colors are defined based on the comparison of historical returns with the VAR bounds. 5. A scatter plot is created to show dates from the returns_2020 inches dataset and risk levels based on VAR bounds. 6. The plot is titled, Filtered Historical Simulation VAR, and a legend is added to represent different risk levels using colors. This code helps investors visualize and analyze potential risks in their investment portfolios by comparing historical returns with calculated VAR levels. It enables investors to understand the risk-return profile of their investments better and make informed decisions about portfolio management strategies.